At the end of the day, investing is all about risk and reward. And one company that I'm at least intrigued by today is Canoo. Now, the company is in terrible financial position, has been burning through cash, has basically no revenue, but there could be actually be a lot of upside given the price of the stock. So I want to dig into how this company survives and could ultimately end up thriving long term in the electric vehicle space. I want to put up front that this is a very high risk investment, but the point is that the reward could also be very high. So I want to dig into this to see if that risk reward balance is even worth thinking about for investors. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. Go to fool.com/ASYM for their top 10 stocks to buy right now. Now let's give a quick overview of what Canoo is as a company. Now, Canoo is fundamentally an electric vehicle company, just like a dozen other electric vehicle companies that have come public over the last few years. But it's a little bit different in that it's creating a vehicle that is very modular and is very unique in its design. So I'll go through just a couple of these. The LDV 190, built to be kind of like a van or SUV. The LDV 130, the LV vehicle. And then they also have a pickup, which you can see right here. Very similar design, again, modular design. And then the MPDV, which they have announced recently. The challenge is that they've designed these vehicles years ago, but haven't actually produced many of them. What they are starting to do is deliver some of these kind of prototype vehicles. They had the astronauts transported in Canoo vehicles recently. Walmart has made an order. Zeba says it's going to be buying 3,000 Canoo vehicles. So there's a backlog of orders, and there's a lot of companies that are at least interested in trying these vehicles, but we're still in very early phases of them actually producing them. So let's get to the financials. Any sort of look at Canoo's financials, and you could easily just blow the company off. $519,000 in revenue and a loss of $384,000 on that revenue in the most recent quarter, the third quarter of 2023. So that means that they're basically generating no revenue from selling vehicles. That's what's going to be scaling in 2024. And then they're spending about $50 million per quarter in operating expenses. Add in financial changes and you get a loss of $112 million in the most recent quarter. From a cash perspective, things look even worse. I'm going to start with the cash burn side of things. This is the 9 months ended September 30th, 2023. Cash burn from operations, $191.4 million. And then capital expenses were another $45.4 million. So over $200 million in cash burn from basically just operating and scaling the business. And the balance sheet just simply can't sustain that. Again, this looks really bad. $8.3 million in cash, $3.8 million in restricted cash. So Canoo was quickly running out of cash. There is a reason the stock has absolutely collapsed over the past year. 21 cents per share right now, down 80%, and a market cap of just $168 million. But the reason to be a little bit optimistic is that cash isn't exactly running out because there are ways that they can tap money for future sales. This is their latest presentation, and they said that in the last year, they have raised total capital of $253 million. There are prepaid advance agreements. This is with Yorkville Advisors. I'm going to get to this again in just a second. And then an at the market program. This is basically just selling a stock at the market price of the stock. So 20 cents a share for shares, they could sell stock to raise money that way. It's something they have done previously in 2023. But the interesting thing is this prepaid advance agreement. This is basically saying, hey, we know that revenue is going to come in the door eventually. We want to get this revenue ahead of time. So can we effectively borrow against that future revenue? And this is something that Canoo has done recently. So this agreement was come to on July 30th, 2022. And on December 20th was the most recent time that they tapped this agreement with the Yorkville Advisors, got $16 million and waived certain conditions. So the net for the company will actually be about $15 million. So this is one way to tap the market without being too diluted, without just going to the market. You can see that they could buy shares at 28 cents per share as part of this purchase agreement. So the company is raising capital to get to the point where it can actually manufacture and make money. And this is where things get really interesting, because what I would think, just looking at Canoo from a distance is that the company was really in decline and running into financial trouble. So you're going to kind of stop operations. But it seems that they're actually moving forward. They recently bought some manufacturing equipment, said that they bought it at 80% of estimated value. That's going to be going into their Oklahoma City facility and will allow it to make additional customer deliveries in 2024. So they're still moving forward with this. At the same time, they're also hiring new executives and they're signing new contracts. So named Michael Carter, Chief People Officer, signed a contract with Primetime Shuttle for 550 electric vehicles. So the business continues to move forward. It's just a matter of, are they going to get to the point where they'll actually be sustainable? This is where I again go back to the income statement. And what I think is interesting for Canoo compared to a lot of other electric vehicle companies is if they are actually able to produce these vehicles, they have relatively low operating expenses. Research and development expense, $22 million, SG&A, $25 million. There's a little bit of depreciation in here. That's a non-cash expense. But $50 million or so in run rate operating expenses is not very high for an electric vehicle company. So if they are able to produce thousands of vehicles per year, they could actually get to a cash flow positive point much quicker than a lot of their competitors could because they have much higher cost bases. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. On top of the capital that I talked about Canoo raising recently, they closed a $45 million convertible preferred investment in October. So that's a little bit more money coming in the door. They're expecting customer deposits to start soon. And they have plans to eventually get to 40,000 units in production capacity. So that's a pretty big production capacity for a company of this size. And like I said, if they're able to get there, if they're able to bridge the point that they're at today to the point where more money is coming in the door, that could ultimately give them enough financial leeway to survive as a company. And as an investment, the price is so low today that I think the risk reward is a little bit compelling. Now, this is not a stock that I own. I don't currently plan on buying any shares, but I am going to dig into it further over the next couple of weeks. And if Canoo starts to deliver vehicles in 2024 and that order backlog, which is about $3 billion today, starts to pick up, I think this is a really compelling company if it can survive. And the challenge there is if there's a 1% or a 5% chance of survival, then there could actually be value in the stock. But you have to understand that in both of those cases, there's a 95 to 99% chance that the stock goes to zero if the company ends up having to go into bankruptcy. But certainly seems like they have been able to bridge the gap so far. The funding sources, whether it's from their institutional partners or from potential customers, do seem to be available for Canoo. So that's what I think is ultimately really interesting. It seems like these customers really want them to survive. I would love to see a unique electric vehicle in the market. Seems like they're going to move more to those fleet customers first, but even as a traditional vehicle, whether it's the pickup truck or as something like a van or SUV, I think this is a really compelling offering. And so I would love to see a company like this make it, but the financial challenge is enormous. For investors, you're taking a big risk, but there's also potentially a big reward. So check back in this channel for more coverage on Canoo in the future. Let me know what you think about the stock and about the company. What do you think about the risk reward? Love to hear those comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.